The credit card company just sent Susan a thank you note, not really, but they might as well have. She made every single minimum payment on time, did everything right, and somehow ended up owing more money than when she started. That is not a budgeting failure, that is a math trap, and it is engineered that way. When your annual percentage rate is hovering around 24 or 25%, the interest that accrues each month can actually outpace the minimum payment the lender requires you to make. Think of it like running on a treadmill that keeps speeding up just slightly faster than your legs can move. You are working hard, you are sweating, you are showing up, and you are still sliding backward. The lenders are not villains in a comic book, but the system is designed around something called the minimum payment trap, and understanding it changes everything. A minimum payment is typically calculated as a small percentage of the outstanding balance, sometimes as low as 1 or 2%, which means on a $5,000 balance, you might owe $60 or $70 a month. Here is the cruel irony. At 24% annual percentage rate, that same $5,000 balance generates about $100 in interest every single month. So your $60 payment is not paying down debt. It is not even keeping up with the interest. This is where the balance grows without you doing anything reckless, without a shopping spree, without a single new purchase. Susan is not irresponsible. Susan is caught in a current stronger than her paddle. Now, financial media in the early 2020s was celebrating the resilient consumer, pointing to strong spending as a sign of economic health. What they did not always show you was how much of that spending was being financed at rates that would make a loan shark blush. Economists call this debt servicing capacity, the ability to actually reduce what you owe rather than just tread water. When rates are high and balances are large, millions of households lose that capacity entirely, and the psychological toll is real. There is a phenomenon behavioral economists call debt fatigue, where borrowers who feel like they are doing everything right but seeing no progress simply give up. The dangerous irony is that giving up stopping payments, missing minimums, is the exact moment the trap slams shut hardest. History has seen this before, by the way. The 1980s brought credit card deregulation, rates shot into the high 20s, and consumer debt exploded in ways that shaped a generation's relationship with money. The pattern is not new. Only the names and the balances change. So what do you actually do if you are Susan? The most battle-tested strategy is the avalanche method attack the highest interest rate debt first, with every extra dollar you can find, while paying minimums on everything else. It is not glamorous, it does not go viral, but the math is ruthlessly in your favor. The other misconception worth destroying right now is that carrying a balance builds credit. It does not. And that myth has cost people thousands of dollars in unnecessary interest payments. What builds credit is utilization management and on-time payments, not feeding the interest machine voluntarily. Discipline here does not mean white-knuckling a budget forever. It means making one structural decision, like a balance transfer to a 0% promotional rate, or a personal loan at a lower fixed rate, and then not touching the card while you pay it down. Process over panic every single time. At the philosophical level, debt is just borrowed time. You are pulling future income into the present, and high interest rates mean you are paying an enormous premium for that borrowed time. The borrowers who win are not the ones with the most conviction about their financial future. They are the ones with the most consistent behavior in the present. And if you are feeling trapped right now, that feeling is data. It is telling you the current structure is not working, and structure can be changed. Whether it is real estate investing to build assets, home improvement to build equity, or finding the right lending partner to restructure your costs, we can help you get started. Check out our links in the description below.